Welcome back to Talk Tickers. We're the deep dive that takes you right inside the earnings calls, giving you the analysis you need. Today, it's all about the Renault Group. Their Q3 2025 revenue numbers dropped just before the Paris Open, and, well, it's a bit of a puzzle. We've got a revenue beat, some pretty solid volume growth, management sounding confident, but the market, not so sure. Choppy trading, lots of skepticism. So our job today is to figure out why this performance isn't quite landing with investors. What's the disconnect?
Yeah, it's that classic good numbers, bad reaction story, isn't it? If you just look at the headline figures, Renault definitely delivered. Total revenue for the quarter, $11.426 billion.
Okay, and year over year.
That's up 6.8%. And actually, if you strip out the currency volatility, which was significant, it's up a strong 8.5% at constant FX.
Right, and that 6.8% reported number, that was above what people were expecting.
Oh yeah, comfortably. The company compiled consensus. What the analysts were looking for was around 6.2% growth. So a decent beat there.
Driven by selling more cars.
Absolutely. Volume was the key driver on the surface. Global registrations jumped 9.8% compared to last year. That's nearly 530,000 vehicles.
So revenue beat, volumes up. Yet the stock had a shaky day. Why the nerves? Feels like the market's worried about something else. Margins, maybe?
That's exactly it. Future profitability is the big question mark. But look, management tried hard to address that. They stood firm on their full-year guidance, the targets they set back in July. They're still aiming for a group operating margin of around 6.5%.
Okay, holding the line there. And cash flow.
Same story. Free cash flow, or FCF, target remains between €1 and $1.5 billion for the full year. They're basically saying, trust us, Q4 execution will get us there.
All right, let's get into the specifics then. The main automotive business, that's the core, right? Revenue there was $9.816 billion, up 5.0%. Their whole strategy is value over volume. So how did that play out in the actual revenue drivers this quarter? Did the value part work?
Well, yes and no. The positives show the strategy has legs, at least on the mix side. Volume itself added 3.2 points to that revenue growth. Then you had geographic mix adding a full point. That's interesting because it partly reflects them selling less in lower margin places like Brazil, focusing more on Europe.
Shifting the focus.
Yeah.
And product mix. Better cars.
Yep. Product mix contributed 0.9 points. That's thanks to new models like the Dacia Bigster and the Renault 5 E-Tech doing well. So, yeah, selling, richer mixed vehicles and generally better markets.
But there's always a but.
Yeah.
The headwinds. Currency and pricing, the two things everyone's watching. How bad were they?
They were pretty brutal, frankly. Foreign exchange was a major drag, pulling that revenue growth down by 1.8 percentage points. It's like a world tour of currency pain. The Argentine peso, the Turkish lira, the Brazilian real, all weighing heavily. It really offset some of the operational gains.
Okay, so FX took a big bite. And pricing. This is the hot topic in Europe right now. Did we see the pressure?
We absolutely did. And this ties directly back to that market skepticism you mentioned. The price effect was a negative 0.8 points. Management didn't hide from it. They said it was down to a, quote, highly challenging commercial environment and strong pressure, especially in Europe.
And that's the worry for investors, isn't it? They see negative pricing, and they immediately question if that 6.5% margin target is really achievable long-term without huge cost cuts.
Precisely. It puts enormous pressure on cost control and future product launches to offset that headwind.
Which brings us nicely to the part of the business that's supposed to smooth things out. Mobilize Financial Services, MFS, the finance arm.
MFS is, well, it's crucial right now. It's acting as a really important buffer. Their revenue just soared up 18.4% to nearly $1.6 billion.
Wow, 18.4%. How?
Two main things. Higher interest rates flowing through on the loans they hold, and also the higher average selling prices of the cars being financed. Their total assets, the performing ones, grew too, up 5.3% to $59.5 billion.
Okay, but hold on. If higher interest rates are juicing those revenues now, isn't that a bit of a temporary boost? What happens if rates come down? Does MFS become less of a shield?
That's a fair question, and definitely something investors are thinking about. The rate of growth might slow down, sure, but management would argue the underlying strength comes from their sales discipline in the auto business. They pointed out their retail sales mix selling to individuals, not fleets, was 63.8% in their top 5 European markets.
And why does that matter for MFS?
Because it's way above the market average, like 20 points higher.
Yeah.
Selling retail helps protect the used car values, the residual values of the vehicles MFS is financing. Better residuals mean lower risk on that $59.5 billion asset book. So they're trying to manage the quality even if the growth rate moderates.
Got it. Protecting the asset base. Now, there was also a little accounting tailwind this quarter from a structural change, something in India.
Right, the RNA IPL facility consolidation, they took full control from August 1st. That change meant they booked more sales to partners' revenue, giving a 1.6-point lift to that category. It's more about operational structure, long-term, better logistics, export potential, not necessarily high-margin sales, but it cleans things up.
Okay, let's talk electrification. That's becoming a bigger and bigger part of the story, especially with regulations like CAFE in mind. How's the mix looking?
It's definitely shifting. The overall electrified mix, so that's battery electric vehicles plus hybrids, hit 44% of their sales in Q3. Pure EV share reached 13.5%. That was massively boosted by the Renault brand itself. Their EV sales shot up 85%, thanks mostly to the new R5 and the Scenic E-Tech.
And hybrids.
Yeah.
That feels important for meeting near-term targets.
Hugely important. Hybrid electric vehicles, HEVs, were over 30% of sales. And look at Dacia, their hybrid sales more than doubled. It shows the technology is landing, even with their, very value-conscious customer base.
And that hybrid strength is presumably helping them with the big regulatory headache, CAFE phase CO2 targets?
Yes, that's the direct link. Management sounded pretty comfortable about meeting the passenger car CAFE targets, largely because of that strong hybrid performance. And it's a significant, but LCVs, the vans and light commercial vehicles, are still a worry. Electrification there is lagging way behind cars.
So that's where the potential penalties lie.
That's the biggest risk area, yes. And we know it's real because they already took a provision for it.
Ah, right. How much was that?
They booked a $90 million provision back in the first half of this year, specifically for expected LCV compliance penalties. That's a direct hit to the bottom line, and it just reinforces why the market is jumpy about that 6.5% margin target holding up.
Okay, so that brings us to the near-term picture, Q4. They need to hit that free cash flow guidance range, 1.0 to 1.5 billion. You said it hinges on working capital.
Almost entirely. That wide range. It basically reflects uncertainty around working capital swings in Q4. Inventory is key here. They ended Q3 with 538,000 vehicles in total inventory. The plan is to finish the year somewhere between 525,000 and 550,000, so pretty tight control. They even trimmed Q3 production a bit to manage it.
And managing that inventory down generates cash.
Exactly. They need to sell down that stock efficiently in Q4 to unwind the negative working capital build we saw in the first half. The risk is needing big discounts to shift metal, which obviously hits margins again.
Makes sense. But you need demand to sell inventory. How's the order book looking?
It's a mixed picture. The overall European order book is a bit lower than it was in June, now about 1.6 months worth of sales. But crucially, the actual order intake, the new orders coming in during Q3, was up by high single digits compared to last year.
Okay, so new orders are still flowing in. Any difference between cars and vans?
Yeah, interestingly, LCV order intake was even stronger than passenger cars. So the forward demand signal, especially for commercial vehicles, looks pretty robust. The question, as always, is converting those orders at good prices.
Right. Let's shift to the longer-term picture, the things that could really change the narrative for Renault if they get them right. You mentioned battery tech and the next strategy plan.
Yeah, these are the potential game changers the market maybe isn't fully pricing in yet. First is the switch to LFP lithium iron phosphate batteries for their EVs. That's a major cost play. It starts next year, 2026, with the new Dacia Spring model, then rolls out to the R5, the upcoming R4, the Megane, basically the core EV lineup.
And LFP is cheaper.
Significantly cheaper than the current nickel-based chemistries. This is absolutely vital if they want to compete effectively, especially with Chinese EV makers, and get towards that, cost parity goal. It allows them to credibly target that sub 25,000 EV segment.
So it's fundamental to their EV profitability going forward.
Totally fundamental. And this focus on cost feeds directly into their next big strategic update, which is planned for Q1 2026. They signaled clearly that while product will still be key, the big shift in emphasis will be towards, almost an obsession with fixed cost control and making the business more resilient, improving the break-even point.
How are they planning to do that?
They talked about strict capital discipline, keeping CapEx and R&D combined below 8% of revenue. It signals a real commitment to de-risking the model, making it less vulnerable to swings in volume or price.
Which is important context because, as we said, the stock's taken a beating. How bad has the underperformance been?
It's been rough. Over the past year, Renault stock is down something like 18%, while the main French index, the CAC 40, is up nearly 9%. That's a huge gap. And a lot of that negativity stems from the guidance reset they had back in July. The market just hasn't regained faith in the margin story yet. They see the current headwinds, like pricing, more clearly than the potential future benefits of LFP or cost cuts.
Okay, perfect setup. Let's pivot to our favorite segment. This is not financial advice. Imagine we're pitching to an investment committee. We need a bold, maybe slightly outrageous, but still plausible trade idea based on everything we've just discussed. What's the pitch?
All right, committee. Here's the pitch. The market is making a mistake. It's looking at Renault and seeing only a classic, old-school, cyclical European car maker bleeding margin in a tough market. It's completely overlooking, or at least underweighting, two massive structural factors: the incredible resilience and profitability of Mobilize Financial Services and the fundamental cost transformation coming with LFP batteries and the 2026 plan.
So the market's got tunnel vision on the immediate EU auto cycle weakness.
Yeah.
How do we play that mispricing?
Simple structure. We go long Renault, stock R&O, and we finance it by going short one of its European peers.
Which peer? What characteristics are we shorting?
We short an OEM that is highly exposed to the same EU cycle, lacks a strong captive finance arm like MFS to buffer earnings, and critically has a significant LCV business that faces potentially greater CAFE compliance risk and penalty costs than Renault does.
Okay, so it's a relative value play, isolating Renault's specific strengths. What's the core rationale boiled down?
You're betting that the high-return, growing MFS business, remember up 18.4%, continues to provide a powerful earnings cushion that the market isn't fully appreciating. And you're betting on execution. You believe they will successfully transition to lower-cost LFP batteries starting next year, fundamentally improving EV margins. Plus, that Q1 2026 plan focused on fixed costs and break-even. That's basically a free option right now that the market, obsessed with Q3 pricing, isn't valuing. We're buying a transition story that's financially stronger than it looks.
A financially armored transition story. I like that. It's definitely playing the long game against the short-term noise. All right, let's bring it home. For you listening, what are the key things to take away from this Renault deep dive? Well, clearly, a solid revenue beat on the surface, driven by good volumes and that very strong performance from Mobilize Financial Services. But, and it's a big but, that was overshadowed by clear signs of pricing pressure in the core auto business, ongoing FX headwinds, and lingering investor doubts about whether they can really sustain that 6.5% margin target, especially with the LCV regulatory costs looming.
Yeah, and maybe the most interesting thing to chew on, thinking longer term, comes back to that 2026 strategic plan. Management is talking a lot about fixed cost control, about improving the break-even point, making the whole operation more resilient. So the provocative thought is this: is the market fundamentally underestimating how quickly this historically quite heavy, cost-intensive company could actually de-risk its entire business model? If they nail that break-even stability, forget Q4 working capital for a second, the whole valuation could look very different, much faster than people think.
Definitely something to mull over. Can they pivot from cyclical auto to a more resilient, de-risked industrial? That's the multi-billion euro question. We've certainly covered a lot of ground today on Renault's Q3. We hope this deep dive gave you the context you need. Feel free to explore the details further.